Welcome back to the Property Investing Roadmap podcast.
An investment in knowledge always pays the best dividends.
My advice is consider the long term, the medium and the now.
I'm your host, Damian Collins, here to help you navigate the twists and turns of property investing.
If you're wanting to snap up those opportunities in a competitive market, you need to be on the ball and be ready.
The first part is start early.
What's your goal in investing?
In Season 2, we're shifting gears to accelerate your journey through 9 key steps to financial freedom. From research and strategy to creating a model property portfolio, this is your step-by-step roadmap to building an income from property for life. Welcome back. Today we'll be covering Step 5 of the 9 key steps to building an income from property for life, which is the model portfolio strategy. Now, today's episode is going to be a little bit different from our usual format. Instead of interviewing a guest, I'll be sharing my personal experience and detailed strategy on how I've built my own property portfolio and the model strategy I recommend to our clients. I'm going to walk you through specific numbers and calculations to show you examples of how this strategy works in practice. My goal is to give you a roadmap that you can adapt to your own circumstances and financial goals. Please note that the content in today's episode is general in nature and for educational purposes only. Always seek independent professional advice before making any investment decisions. So let's dive in. My own property journey began with residential property, and there's a good reason for that. Residential property is the perfect launching pad for any investor looking to build significant wealth through real estate. Now, when I started out, I quickly realised that residential property offered many advantages. The first thing that was most important is that it's easy to finance. Banks view residential property differently. They're much more comfortable with it as security, which means you can access higher loan-to-value ratios than with other property types. In some cases, potentially as much as 95%. For my first residential investment, I remember the lending process being far more straightforward. It was relatively simple. All I had to do was give them a payslip, show some evidence that I could service the loan, and I got high loan-to-value ratios. But I knew people who were investing in commercial property, it was much more difficult for them to get a loan. So residential was the place that I wanted to start. Now, of course, I made mistakes along the way, and there were plenty of them. I initially underestimated the importance of location. I spent too much time looking at properties based on rental yield rather than growth potential. Now, rental yield is really important, of course, because it helps us pay the bills. But focusing too much on immediate returns rather than long-term capital growth is a common error for new investors. As Warren Buffett famously says, price is what you pay, but value is what you get. Now, typically building a property portfolio encompasses 3 key phases. Let me show you exactly how it works with some numbers. If we look at a $600,000 property growing at 6% compound annually, by the end of year 1, it would be worth $636,000. By year 2, it reaches $674,000, and after 5 years, the same property would be worth around $802,000, giving you significant equity to work with. But here's where it gets really interesting. If you're able to buy a second property using that equity, you now have 2 properties growing in value. The first property continues to grow, and that reaches $851,000 by year 6, while your second property starts its own growth journey. The compounding effect is how you build significant wealth through property. In fact, using this approach strategically, you could build a portfolio that looks something like this. 3 residential properties at $600,000 each, 1 commercial property at $1 million, and then add 2 more residential properties at $600,000 each. This gives you a total portfolio of $6 million, generating a net yield of 4.5% or about $270,000 in annual rental income. Now let's break it down how this develops phase by phase. In the first phase, it's about using maximum lending ratios to acquire residential properties. In my early investing days, I was focused on getting into the market with the smallest possible deposit. I remember my first investment property had a loan-to-value ratio of nearly 90%. The property was negatively geared for the first few years, costing me about $100 a week after tax benefits. But that initial sacrifice was worth it. Within 5 years, the property had grown enough in value to fund my next purchase. The key in this phase is momentum. You want to get into the market and start building equity as quickly as possible, while your income from employment can support any shortfalls in cash flows. Then we get into the second phase. As my portfolio began to grow, I started transitioning to phase 2, which is adding commercial property to the mix. This is where you take on slightly higher risk in pursuit of higher returns. In my own journey, this transition definitely wasn't without challenges. Commercial property comes with different considerations, including longer potential vacancy periods, more complex tenant requirements, and typically higher deposits. But the rewards can be substantial. I remember buying my first commercial property, a small retail space that was yielding 7.2% net. The residential properties in my portfolio at that time were yielding around 3.5% net. So this was a significant improvement in cash flow. But more importantly, it marked the beginning of my transition from negative to positive gearing across my overall property portfolio. Now let me walk you through some specific calculations. Commercial property rental yields vary over the cycle, but let's work on an average gross yield of about 7.5%. And because the tenant pays most of the outgoings, if not all, the net yield might be around 6.5%. Compare this to residential property where you get a gross yield of perhaps 4.5%, or in some cases even less, but a net yield of only 3% after expenses, because in residential, the owner has to pay almost all the expenses and outgoings on the property. So you can see why adding commercial property becomes so valuable. And remember, you don't have to invest in commercial property directly. You could also consider investing via a property fund, as we've discussed in other episodes. The final phase of building a property portfolio is aimed at achieving financial freedom. This is where you balance your property portfolio to create a sustainable income stream that can replace your employment income or your income from business. Now, in my experience, the ideal balance is about 50% residential property and 50% commercial property. This mix delivers a blended net yield of around 4.5% across your entire portfolio, which will provide you with substantial income while maintaining good prospects for ongoing capital growth. Now, let me give you a detailed yield calculation. If your residential properties deliver a 3% net yield after all the expenses and commercial properties deliver around a net 6% yield, a portfolio with equal value of residential and commercial property will generate a 4.5% net overall yield. Now, on a $6 million portfolio, that's around $270,000 per annum in net rental income after all expenses. Now, that's certainly enough money to fund a comfortable lifestyle for most people. One of my most successful strategies has been adding value to properties through renovation. Let me walk you through a specific example. I had a property where we took a strategic approach to renovation. Rather than a complete overhaul, we focused on high-impact, cost-effective improvements. We started with a property that was structurally sound but a bit dated. For a reasonable cost, we were able to refresh the kitchen, update the bathroom, polish the floorboards, and improve the street appeal through landscaping and painting. A good renovation can deliver $2 in value for every dollar you spend, and that's exactly what we aim for. What is interesting is that these improvements not only increased the property's value, but also attracted better quality tenants, and so I got a higher rental return. The property had been renting for $450 a week, but soon commanded $550 a week after the renovations, a 22% increase in rental income. So not only did I have a higher capital value, I had a higher rental return. Now, the key to success in this example was understanding the local market. We knew this area demanded mid-level finishes, so spending on high-end luxury fittings would have been over-capitalising. By matching our renovation to market expectations, we maximised the return on investment. Now, let's take a look at what a model property portfolio might look like in practice. I believe the ideal approach for most investors begins with acquiring 3 residential properties. So for this example, we'll assume they're worth $600,000 each at the time of purchase. Once these are established and have grown in value, we'll consider adding commercial property valued at around $1 million. As your portfolio matures and your equity position strengthens, consider adding 2 more residential properties, and again we'll assume they're worth $600,000 each. Then we'll add 2 more commercial properties, assumed about $1 million each. The end result is a portfolio valued at $6 million that's balanced between residential and commercial assets. The balanced portfolio has the potential to generate a net yield of 4.5% after all expenses, providing an annual income stream of around $270,000. That's a substantial passive income that can support a very comfortable lifestyle, with the added benefit that it should continue to grow at or above the rate of inflation. Now, while this is the model property strategy, of course, your journey might look different, and that's perfectly fine. We all start from different points with varying risk profiles and different financial circumstances. For example, if you're starting with limited capital, you might begin with a single property and focus on capital growth before expanding your portfolio. If your risk tolerance is lower, you might opt for a property with stronger cash flow rather than maximum growth potential. Market conditions will also influence your approach. In a rising market, growth properties may be the focus. In a flatter market, property yield might become more important. The key is to adapt these principles to your unique situation while keeping the end goal in mind. Your personal circumstances matter as well. A young couple with growing careers might accept more negative cash flow than someone approaching retirement. A high-income earner might accelerate the process by investing in multiple properties simultaneously. When it comes to the calculations, the power of compound growth cannot be overstated. A property growing at 6% annually will nearly double in value every 12 years. Over a 25-year investment horizon, that $600,000 property could be worth over $2.5 million. Multiply that by multiple properties in your portfolio and you can see how significant wealth is created. The comparison between residential and commercial yields is also worth looking at. While residential properties might yield 3 to 4% net after all expenses, as I said earlier, commercial properties can deliver a much better yield, around 6 to 7% after expenses. This difference becomes increasingly important as you transition from wealth accumulation to income generation to live on in your retirement. Value-add strategies like renovations can supercharge these returns. A well-executed renovation might cost, say, $50,000, but it could add $100,000 to the property's value while also increasing the rental return by 15 to 20%. These improvements can significantly accelerate your wealth-building timeline. However, as we've covered in other episodes, building an expert team around you to help you navigate the complexities of the property market is absolutely crucial. Now, we've covered a lot of ground today, so let me recap the key points. My approach is to start with residential properties using maximum leverage to build your initial portfolio. As your equity position strengthens, transition to a more balanced portfolio by adding commercial property. Aim for a final balance of around 50% residential property and 50% commercial property to achieve a long-term sustainable income stream. And remember that strategic value adding through renovation can accelerate your progress at every stage. The most important thing to understand is that this strategy needs to be adapted to your personal circumstances. Whether you're just starting out on your property journey or you're well on your way to financial freedom, the principles we've discussed today should be tailored to your unique situation. Your journey is not going to be in a straight line. There's going to be highs, there's going to be lows, but if you're in the market for long enough and you make good quality decisions, you will come out at the end with financial freedom. And remember, time is our most valuable asset. Thanks for spending some of your time with me today. In our next episode, we'll be looking at how you identify and acquire the best commercial properties for your portfolio, including how you can access quality commercial properties for as little as $25,000. Thanks for tuning in. If you're enjoying the podcast, please take a moment to rate us to help others discover the show. Please note that the information shared on Property Investing Roadmap is general in nature and doesn't take into account your individual circumstances. The information is for educational purposes only and should not be relied on for investment or financial decisions. Always seek professional advice before deciding whether to invest.